Welcome to US Market Pulse. If you follow silver seriously, not as hype, not as memes, but as a real global market, today's story should stop you cold. In a single day, physical silver prices in the UAE jumped from roughly $95 to over $127 per ounce. That is a 34% move in one day in a real physical market. At the exact same moment, the official Western price you see on your screen on COMEX and LBMA showed silver trading near $72. That is not a small premium. That is not normal regional pricing. That is not arbitrage noise. That is a fracture. And the most important question today is not why silver is expensive in the UAE. The real question is this: why is silver still cheap in the West? Because both prices cannot be correct at the same time? Let's be clear from the start. This is not conspiracy. This is not social media drama. This is market structure breaking in real time. Right now, physical silver in parts of the Middle East and Asia is trading at $90, $100, $120 and rising. Meanwhile, Western paper markets are acting as if nothing unusual is happening. That tells us something critical. Price discovery is no longer global. What we are seeing is the emergence of two silver markets. One market where real metal changes hands. Another market where paper contracts trade against each other. And those two markets are drifting further apart every week. This matters because COMEX and LBMA exist for one reason: to provide a reference price for silver. But a reference price only works if it reflects reality. When buyers in Dubai pay over $120, when Japan pays over $100, when Korea, Kuwait and even large retailers show prices near $90 just to deliver metal, a benchmark stuck in the low 70s is no longer a benchmark. It is fiction. Now let's talk about the UAE specifically. Dubai is not a fringe market. It is one of the world's most important physical precious metals hubs. It does not trade paper promises. It trades bars, coins, inventory. And reports coming out of the region show not just higher prices but inventory shortages. Silver is being bought faster than it can be restocked. That distinction is critical. High prices without shortages suggest speculation. High prices with shortages signal real demand stress. And this is where Western investors often make a dangerous mistake. They look at COMEX prices and conclude silver is cheap. But the rest of the world is telling you silver is scarce. Those are not the same statement. Scarcity always wins. Always. Ask yourself something honestly. If silver were truly worth $72, why would anyone in Dubai pay $127? They wouldn't. Markets are not charities. This gap exists because Western markets are dominated by paper supply, while Eastern and Middle Eastern markets are increasingly physical first. Paper silver can be created instantly. Physical silver cannot. That difference is now showing up in price. And this is only the beginning. Because once physical markets stop respecting Western reference prices, COMEX and LBMA lose authority. And when a benchmark loses authority, it does not collapse gradually. It collapses suddenly. Now let's talk about the uncomfortable truth that many people avoid. The silver price you see on your screen is not a physical price. It is a derivatives price. COMEX and LBMA do not primarily trade silver bars. They trade contracts, promises to deliver silver at a later date. And the volume of those promises dwarfs the amount of real metal available. For every ounce of silver that can actually be delivered, there are dozens, sometimes hundreds of paper claims attached to it. This system only works as long as most participants never ask for delivery. The moment delivery demand rises, the illusion cracks. What we are seeing in the UAE, Japan, Korea and across Asia is delivery demand. People are not trading silver. They are buying it. That difference is everything. Western investors often assume arbitrage will fix price gaps. In theory, traders should buy silver cheaply in the West and sell it expensively in the East. But here is the reality they ignore. You cannot arbitrage what you cannot source. If you cannot get physical silver in size, at scale, on time, arbitrage is meaningless. Paper silver does not ship. Futures contracts do not melt. This is why the disconnect is widening instead of narrowing. Across the West, dealers report the same pattern. Large bars disappear first. Premiums rise quietly. Restocking takes longer each cycle. This is not temporary tightness. This is systemic depletion. And here is where people fool themselves. They say if silver were really scarce, COMEX inventories would be empty. That is a wrong assumption. COMEX inventories are not the global silver supply. They are a registered subset governed by rules that allow metal to shift categories, remain idle, or be rehypothecated unless forced into delivery. Scarcity does not show up first in vol totals. It shows up in availability. If delivery takes weeks instead of days, if you must accept smaller sizes, if premiums rise regardless of spot price, you are already in a shortage, even if the charts look calm. Now let's talk about the real catalyst most analysts are missing. China. China is not just another silver producer. China is one of the largest miners, one of the largest refiners, and one of the largest consumers of silver on earth. That combination matters more than any chart. Recent signals indicate restrictions on silver exports following the same strategic playbook used for rare earths. This is not theory. This is policy. Export restrictions do not cause temporary price spikes. They change market structure. When silver that once flowed freely into Western markets is redirected internally, Western deficits do not disappear. They compound. The global silver market has been running structural deficits for years. 6 consecutive years where demand exceeded supply. More than 1 billion ounces cumulatively. That cannot be fixed with sentiment. It cannot be fixed with interest rates. It cannot be fixed with paper contracts. Now add export controls on top of that. Western markets assume metal will always appear if the price is right. That assumption only holds when producers are willing to sell. China is signaling that domestic strategic use now takes priority. And silver is strategic. It is embedded in solar panels, electric vehicles, data centers, military systems, medical technology. These sectors do not substitute easily. They do not wait for pullbacks. They secure supply or production stops. That makes industrial demand inelastic. When inelastic demand meets restricted supply, price does not rise slowly. It reprices. This is why COMEX sits uncomfortably in the middle of this story. COMEX does not mine silver. COMEX does not refine silver. COMEX does not allocate silver to factories. It is a financial layer sitting on top of a physical system that is tightening underneath. That is why the east-west price gap matters so much. Physical buyers are reacting to real constraints. Paper markets are reacting to leverage. Those two worlds are now colliding. And here is the truth most people refuse to say. If Asia and the Middle East decide Western paper prices are irrelevant, Western benchmarks lose power overnight. Price discovery migrates to where metal clears. That has happened before in other commodities. Silver is not immune. Now strip away the noise. Silver is not about to explode tomorrow. But it is also no longer functioning like a normal market. Those statements can both be true. What we are witnessing is a repricing process driven by supply erosion, geographic fragmentation, and declining trust in Western benchmarks. That kind of repricing does not announce itself. It creeps. Then it gaps. The biggest mistake investors make is assuming fundamentals must reflect immediately in price. In leverage-driven markets, fundamentals show up last. Silver has been artificially cheap for years because paper supply overwhelmed physical reality. That mechanism is now under stress. The question is not whether silver rises. The question is how price adjusts when paper loses dominance.